Welcome back, everyone. I am so incredibly pumped you're here for today's explainer. We are diving deep into one of the most highly requested topics we've seen floating around the markets lately, the massive Vedanta demerger. For the longest time, when we talked about this conglomerate, we were just talking about a single stock ticker. But today, the whole landscape has completely shifted. The giant has been split up, and there is so much more happening beneath the surface here than just a fluctuating share price. We're going to unpack exactly what this means for the business, how to actually evaluate these newly separated entities, and what the numbers are really telling us.
Okay, here is our game plan for today. We'll dissect the Great Vedanta split, define the real metrics of size, look at CAPEX for future growth, scout the competition, and wrap it all up with performance and takeaways. Let's jump right in. Kicking things off with Section 1, the Great Vedanta split. So imagine a massive corporate parent suddenly deciding, hey, it's time for the kids to move out and fly on their own. That is literally what a demerger is. Now, just to keep things super clean today, we are leaving Hindustan Zinc completely out of this specific equation. We're just focusing on the core split. We now have 5 distinct entities. You've got the parent company, Vedanta Limited, and the 4 newly independent children born from it: Vedanta Oil and Gas, Vedanta Aluminium, Vedanta Power, and Vedanta Iron and Steel. These aren't just divisions hiding under a corporate umbrella anymore. They are standalone businesses out there facing their own unique challenges and opportunities.
Which brings us to Section 2, Sizing Up, Market Capitalization.
All right, now that we have these 5 distinct companies, you gotta ask yourself, how do we actually decide which one is the biggest? It is so easy to just glance at a really high share price and automatically assume, wow, that must be a massive operation, right? Well, we know that's definitely not the whole story. Think about it like this. If share price alone equaled the size of the company, then MRF, that tire manufacturer with the famously massive price tag for just one single share, would be the biggest company in all of India. But fundamentally, we know that's just not true. Reliance Industries is actually the biggest company in the country, even though its individual share price is way, way lower. Why? Well, it all comes down to market capitalization. Market capitalization, or market cap, is the absolute real metric we use to figure out a company's true size. It's just the market price per share multiplied by the total number of shares out there. It moves every single day, and it's the ultimate ruler we use to separate the heavyweights from the middleweights.
So let's use that ruler to build our ranking for the Vedanta Group, and honestly, the results are pretty surprising. Vedanta Aluminum is sitting way up at the top with an approximate market cap of 1.88 lakh crore. I mean, it is completely overshadowing the others, firmly cementing itself in the large cap category. But here's the crazy part. The aluminum business is now substantially larger than Vedanta Limited, the actual parent company itself, which is sitting at roughly 1.18 lakh crore. And then right below those 2 giants, we have 3 distinct medcap siblings, Vedanta Power at 19,000 crore, and both oil and gas and iron and steel trailing right behind at around 16,500 crore.
Moving right along to Section 3, CAPEX, fueling future growth. Now, CAPEX, or capital expenditure, is literally the price a company pays for its future growth. The market absolutely loves CAPEX. When these companies take their own hard-earned cash and reinvest it to buy or upgrade their physical assets, they are basically screaming to the market, we plan to dominate. To put it simply, think of it like a biscuit factory. Let's say you only have one machine churning out 100 biscuits a day. If you want to double your output, you use CAPEX to go out and buy a second machine. Boom, now your total capacity doubles to 200 biscuits. Expanding that capacity is what drives future revenue, and it is exactly the kind of move we want to see from these newly demerged companies. And when you look at the numbers, the CAPEX pipelines perfectly match the ambitions of these businesses. Vedanta Aluminum is going all in. They're aggressively reinvesting in themselves with a massive 12,500 crore CAPEX pipeline. They are absolutely buying that metaphorical second machine. The parent company isn't slouching either, spending heavily at 10,500 crore. As you move down the list to oil and gas and iron and steel, their investment scaled down naturally to fit their mid-cap size. Meanwhile, Vedanta Power is chilling with a very modest 200 crore in the pipeline.
All right, let's pivot to Section 4, knowing the competition.
It is absolutely crucial to know who you're up against, right? Let's start with the biggest kid on the block, Vedanta Aluminum. Yes, they are huge at 1.8 lakh crore, comfortably sitting in the number 2 spot in their sector. But sitting right in front of them is the Aditya Birla Group's Hindalco. And Hindalco is a Goliath with a staggering 2.5 lakh crore market cap. Vedanta Aluminum has a pretty massive gap to close. Honestly, this explains exactly why their capex is so incredibly high right now. They are playing David chasing Goliath, and they need every ounce of that expanded capacity to catch up. Now, when we look at Vedanta Oil and Gas, the mountain they have to climb is way steeper. They're sitting in third place in their sector with a market cap of around 17,500 crore. Ahead of them is Oil India, and then way, way ahead in the distance is the undisputed government giant, ONGC, flexing a market cap of nearly 3 lakh crore. That is an absolute mammoth of a difference. To even make a tiny dent in that gap, Vedanta Oil and Gas is going to need a seriously exceptional strategy and a whole lot of time. But then you get these fascinating outliers like Vedanta Power. Well, they might be one of the smaller siblings overall at 19,000 crores. Within their specific niche, they are the undisputed number one. Actually, they are nearly 10 times larger than their closest mid-cap competitor in that arena. They completely dominate their playground. And honestly, that probably explains their super low capex. They just don't have a massive giant they need to chase down right now. And that brings us home to Section 5, Performance and Final Takeaways. You know, the stock market is just full of surprises. Since these entities listed independently, it wasn't the biggest, heaviest company that took the crown for the best returns. No way. It was Vedanta Iron and Steel. This entity completely shocked everyone by rocketing up 113%. They literally more than doubled investors' money right out of the gate. Insane, right? But look at the stark contrast here. While iron and steel went straight to the moon, and both oil and gas and power saw really solid, respectable gains of around 17 to 20%, the undisputed heavyweight of the group, Vedanta Aluminum, is actually sitting in a short-term loss of about 11 to 12%. It is absolute proof that sheer size does not automatically guarantee immediate stock market gains. The market clearly evaluates mid-caps and large caps very, very differently in the short term. Oh, and just a quick side note for clarity, because I know a lot of people ask about insider confidence with stuff like this. Because this was a proportional demerger, you don't need to drive yourself crazy digging into 5 different shareholding patterns. Whether you're looking at the promoters, the foreign institutional investors, or the public, the shareholding structure remains exactly the same across all 5 entities. Basically, if you held shares in the parent, you just got a proportionate slice of all the kids. So what is the ultimate takeaway from this whole explainer? It boils down to a fundamental rule of investing. Always evaluate the underlying business. Look at their real market cap, scout their competition, and track their capex. Do not fall for the illusion of a cheap share price. A lower price tag doesn't automatically mean a cheaper valuation, and it for sure doesn't tell you how big or small a business actually is. I want to leave you with this final thought to chew on. When you pull up your portfolio tomorrow, ask yourself, are you buying fundamentally strong businesses with a clear, aggressive path to growth, or are you just shopping for cheap share prices? Thanks so much for joining me to decode the numbers behind the great Vedanta split. Keep applying this kind of structured thinking to your own market research, and I'll catch you in the next explainer.